Hello, welcome. The psychology of speculation. That's what we read today. The human element in stock market transactions by Henry Howard Harper, who apparently was a writer of quite a few books. The library essays. Hmm, Devil's Nest. Okay. So now here we have. This is written in 1926. The stock market literature of the past 30 years would make a vast library in itself. One that would provide reading for a lifetime. Perhaps there is no other subject apart from the eternal topic of love, in which more people are vitally concerned, either directly or indirectly, since most of the country's wealth and commerce is controlled by corporations. Oh, that's true today as well. Whose securities are listed on the various stock exchanges. The price fluctuations, which often reach the daily aggregate of hundreds of millions of dollars, either in loss or enhancement of value, are necessarily a matter of general concern. In 1925, the stock transactions on the New York Stock Exchange alone amounted to the stupendous and unprecedented total of well over 4, 452 million shares. Wow. While the sales of listed bonds totaled more than 3 trillion. Hmm, Okay. Oh, let me see, oh, correction, billion, not trillion. Do not include, oh no, billions of dollars. Okay, let's move ahead. In addition to the large daily grists of market options, many books and pamphlets are written which purport to be guides to traders or up-to-date recipes for beating Wall Street. They set forth an exhausted array of statistics, instructions, and warnings. They furnish elaborately charted plans indicating many of the pitfalls of speculation. They tell how to avoid these and how to buy and what to buy and what to well, talks right. Well, he uses a great deal of words, but he doesn't talk statistics or math. Let's move forward. The pernicious influence of the stock ticker. The individual who trades or invests in stocks will do well to keep away from the stock ticker, for the victim of tickeritis is no more capable of reasoning and self-composed action than one who is in the delirium of typhoid fever. The gyroscopic action of the prices recorded on the ticker tape produces a sort of mental intoxication. Something about Niagara Falls. Intentions have been drawn. We have a cool picture here of a tape reader. Hmm. As the camera fails to record a true picture placed in too close juxtaposition to the object, so in studying the ticker tape one is restricted to a close-up view of conditions, resulting in a distorted gauge of values. For the figures recorded often mislead and confuse the attentive observer. Um, in fact, it appears that the price speculation fluctuations result from a wave of hysteria among the coterie of traders, but bear little analogy to the true value of stocks. To illustrate this point more explicitly, the stock of almost any conservatively capitalized and well-managed concern paying $6 annually in dividends has an investment value of $85 to $100 a share. But in the ups and downs of the market, the stock gets buffeted about the exchange and avoidance. Okay, is that a reference to Warren Buffett? No, I don't think so. But why would they say buffeted? What is the meaning of this? It's like it's buffeted about the exchange in obedience. Okay, let's ask AI what buffeted here means. Is buffeted. Okay, the ups and downs of the stock market gets buffeted. Okay. Buffeted means being pushed, knocked around, or affected repeatedly by outside forces. In your sentence, it's being used metaphorically to describe how the stock price is knocked around by changing trader sentiment. Strike repeatedly. Okay. Out of curiosity, what was this trader? Howard, was he a stock trader? Was he was he a great stock trader? Stock trader? Henry Howard Harper. The short answer, no evidence suggests Henry Harper was a great stock trader. He was an author, not a famous market operator. Henry Howard Harper is often misunderstood because of his book, The Psychology of Speculation. Sounds like it was written by a legendary Wall Street insider, but the historical record paints a different picture. Harper was an author, writer, and publisher. Psychology. His work is observational, not autobiographical. There's no evidence in historical financial literature that Harper was a major Wall Street trader. Okay. So how did his reputation? Okay. Hmm. Hmm. Makes you wonder how did he? What's his authority to speak about the markets? However, this. Let's see. So therefore, he sold more Bethlehem steel. Studebaker car company. General Motors had 100. General Motors, if I'm not mistaken, still trades today. Bethlehem Steel. From this tragic experience, it is obvious that there is too little comfort or profit to be gained on the short side as well for protracted bull market. And the natural inference must be that the long side of such a market is as felicitous and profitable for bulls as the short side is discomforting and unprofitable for bears. In theory, it is, but in practice, there are comparatively few who make large gains and fewer still who get away with them. It's been authority stated by the head of the world's largest gambling emporium that it is impossible for any human being to beat the roulette wheel for any considerable length of time, that the human nature is so constituted that nearly all those who make large winnings continue to play until they have lost all their gains. So this was absolute stock market. Okay, favorite. Look at here. Long run favorable luck will continue stubbornly to plunge long after their luck has changed. Precisely the same psychology applies to trading in stocks. It's basically saying that stocks is speculating stocks is not so different from speculating in the roulette table. Frenzied speculation is the rankest form of gambling and its perilous indulgence. An enormous percentage of stock market speculators become victims of overconfidence after a series of successful trades. Their buoyant spirits increase with every new success, until at length they throw discretion to the winds, extend their risk far beyond the margin of safety, and at the infallible turn of the market they find themselves in difficulties like foolish fishes that get stranded on the beach at high tide. It is a fact, and as inexplicable as it is true, that men with a fair amount of gray matter in their heads who would flout the idea of paying $50 per share for a particular stock will later borrow from a broker at from 6 to 8% to buy the same stock all the way up. Okay. Dangers of inverted pyramids. It's a wise custom of the ancients to build their pyramids with big end on the ground, but the modern pyramid builders of pyramids in the stock markets have reversed this time-honored practice. And most of them build their stock pyramids with heavy end up. Therefore, they invariably topple over after reaching a certain height. Now, is he predicting a market crash? I think he looks like he's predicting a market crash. From here on up, he pyramided, buying 100 shares at every point advance, and wisely protecting his profits with stop-loss orders a few points under the market. Once the market reacted and a few hundred shares of his stock were sold on stop, after which the price recovered, and being assured that the stock had been hampered down for the sole purpose of shaking him out, he bought back the 500 shares at 5 points higher than he had sold it. To prevent another similar coup, he canceled all stop loss orders and took his chances on the open market, confident that he could not be beaten as long as he was trading on velvet with an original investment risk of only 250. Trading on velvet, what does that mean? Okay, let's find out what's trading on velvet. Okay, what is velvet here? Velvet here. Trading on velvet means he was trading with profits, not his own original money. He was. Hmm. Is this term outdated now? Oh, okay. Okay, it's trading with own money. We'll stop here. This book's not very long. You can read it in a couple of evenings. Cool illustrations. There's one way to beat this market. Okay. Thanks for reading.